Thank you, everyone. It's a pleasure to be here. I also like to introduce my partner, Benjamin, from our Paris office. Thanks for coming despite the rain. I thought it was supposed to be sunny in Paris in May. Anyway, I have the pleasure of coming to Paris often and working with Ben and the team that we have here to help give advice to French entrepreneurs and companies that are looking to address the U.S. market. How many of you have already formed a company in France? Okay. And how many are considering either moving to the U.S., seeking U.S. capital, or expanding in the U.S.? Okay, so it looks like about half the companies here view the U.S. as an important market to build in the company, at least initially. What I'm going to talk about tonight are three major topics. The first one is once you establish a company in France, whether it's a group of entrepreneurs or the company, how do you move to the U.S.? The second topic will be different financing vehicles for bringing in angel capital into your company in a cost-effective way, keeping the transaction costs down. And the third major topic will be approaching U.S. venture investors. How do you approach them, and what are the kinds of terms and vocabulary you need to be aware of in addressing U.S. investors? I think as we go along, because there's three topics, and we have about 90 minutes, rather than having Q&A at the end, if you have questions, just raise your hand and let's address the questions as we move along. So where are you now? Many of you are prototyping a product or a service. You're building a team. You're seeking capital. You're working with advisors, such as the family and others here in Paris. You're asking the questions around, what do I do around setting up the company? Should I set up the company in Delaware, or should I set up the company in France? For the most part, our advice is if you are planning to build a global company and address the U.S. market, U.S. investors, and global investors, then we recommend that you set the company up directly in Delaware. And this will be whether your investors are U.S. investors or French investors who can invest in Delaware companies. Now, there are a number of French funds, FCPI, FPCI funds, that are restricted to investing in European companies and cannot invest directly in a Delaware company. But I believe that as there are more angel investors, more micro VC funds here in France, that the opportunities to seek capital here in terms of your seed capital will be greater, and therefore you really need to ask the question, does it make sense to set up directly as a Delaware company? And I'm going to talk about some of the advantages of Delaware companies. The first advantage is access to more capital. I was talking to a banker, First Republic Bank, who's one of the banks like Silicon Valley Bank, last Monday, and he mentioned that the amount of capital that went into venture funds, these are limited partners who invest in venture funds, was $8 billion just in the quarter, which is an all-time high. When we look back historically in terms of money in venture capital back in '99, before the first bubble burst, it was around that level. So we're back at all-time highs in terms of $8 billion of capital, between $30 and $40 billion per year that is going into technology companies. And a good part of that is angel capital. Ease of company sale. If you set the company up as a Delaware company, it does make it easier to sell it to a U.S. buyer. In the U.S., you can sell your company via a merger transaction, and even a tax-free transaction on the Delaware side. So a lot of companies, if they're going to ultimately have a liquidity event, which is a sale of the company, they will consider setting it up as a Delaware company. And for employing people in France, it's quite easy to drop down an SAS or other entity to employ French employees, and possibly even enable those employees to have French qualified options, the BSPCE options, depending on the capital structure of the U.S. company. Y Combinator. How many people may apply or have applied to Y Combinator or an incubator in the U.S.? Terrific. And many companies here that have gone through the family, companies like Algolia, which is a company Ben and I are working with, and several others have applied to Y Combinator, have got accepted into Y Combinator. Y Combinator requires that your company be a Delaware company. Other incubators, such as 500 Startups, don't. Nevertheless, for example, I'm working with a company called Hollydog, which is a French company here. We just flipped them into the US, and they went through the 500 Startups program. I'm an advisor to a company called Clerky.com. Have you guys heard of Clerky? So what Clerky is an online company to incorporate in Delaware, to do your founder stock issuances, and we've made it very easy to incorporate in Delaware. In fact, today, Clerky incorporates over 10% of all companies that are incorporated in the state of Delaware. We're the biggest source of incorporations for the state. And as I mentioned earlier, one of the disadvantages may be it closes the door to European investors. The French SAS, again, if your initial focus is on customers in Europe and employees here, if your capital requirements are not as great, and if you're seeking local investors or government grants and loans, it may be the best option now to set the company up here in France and simply expand in the US. And I think most companies follow this approach, expand in the US via a subsidiary, which, by the way, you can create your subsidiary on Clerky, to hire employees and contract with customers in the US. So if you have already a French company, or if you may go down that route of a French company, then you will eventually, if you're going to seek capital from US investors, you will flip the company into Delaware. There's no issue with French or European citizens being on the board or being officers of a Delaware company. You don't need a US citizen to be your director or your officers, so that makes that approach easy. We usually, in the model for Delaware companies, when you create shares, is to have 10 million shares in the company. That's been the model in the Valley. Some companies will be 20 million shares, but they won't follow the traditional structure here in France of 1,000 shares or 10,000 shares. There's a lot of share inflation in the U.S. So 10 million shares is what you want to think about in terms of your fully diluted shares. And for founders, it means that founders will have common stock and investors will have preferred stock. So we set the company up, and we will take the French subsidiary, and the flip will be an exchange of French company shares for Delaware company shares. I think we have in some of the materials, we've given you some examples of term sheets that you can use to think about how to structure the flip. And the ownership of the French company will be the same as the ownership of the Delaware company. Again, the ordinary shares in the French company will become common stock in the U.S. company, and the preferred shares will become, the preferential shares will become Series A preferred shares in the U.S. company. Intellectual property, I get this question often, which is, what do I do about the IP? Is it okay that IP that's created in France stay in France? And the question is yes, it's perfectly fine that IP remain in France. And if you hire employees in the US, that the IP also be in the US. It's okay to have IP in both locations. The most important thing is that ultimately the French IP be controlled by the US company. And I'll explain in just a second how that works via the exchange agreement. So French shareholders will exchange their stock for US stock. And the issue here, and I'll have Ben speak about this just now, which is the tax issue for French founders. And I have Ben talk about why we need to look at this issue on a case-by-case basis for French founders. Ultimately, the objective is that French founders who are flipping their ordinary shares for Delaware common stock will not pay tax now, but they will need to address it with the French tax authorities.
Yeah, the main issue is actually the way the founders are actually owning their shares. We've got actually two situations. One is an ownership through an holding. So the founders are holding their shares through an holding company. If that happens, actually, you need to get an approval from the tax administration. This is something which is granted by right. So in French, it means c'est attribué de droit. You just have to actually, check all the boxes. The only issue is that this is a little bit time-consuming, and sometimes a flip has to take place very quickly, and that obviously, you have all the tax process to take place. For founders actually owning their shares directly, what they're going to face is a sursis d'imposition or report d'imposition, which means that actually their tax, with respect to the contribution of the shares, we constitute actually an apport en nature, which creates actually a gain, technically speaking, is going to be deferred when they sell their shares of the US company. But as John mentioned, actually, this is a case-by-case analysis basis to see what are going to be the consequences. But just to reassure you, we have never seen so far a situation which has prevented a flip to take place. It just has to be structured accordingly, so the founders, are protected from a tax point of view.
Great. And that's a change in the French tax regime over the last couple of years, where now French individual shareholders can flip into the U.S., and subject to the tax election, French individual shareholders do not need to pay tax now. So they would be parties to this exchange or contribution agreement, which is great because it means that your shares in the SAS become shares in the Delaware company. It's the same percentage ownership of the Delaware company, and you have voting rights and control over the Delaware company. And for the other shareholders who may incur tax, the solution is a deferred exchange agreement. And essentially it says that they enter into an undertaking with the company that in certain events, an IPO of the company, a sale of the company, that they agree today that they will flip their shares in the future. And we've deployed this mechanism, the exchange agreement and the deferred exchange agreement, 20 plus times in the last couple of years for companies that have, as the next step, gotten venture capital in the U.S. And U.S. investors have become comfortable with the deferred exchange approach, which means that the French company, the employees, the IP here is not 100% owned yet by the Delaware company, but there's a contractual arrangement where it will become 100% owned on sale of the company or IPO. And that process is working, as Benjamin has mentioned. We've also addressed it with the tax authorities and haven't had any issues with the tax authorities here either. So it's a bit of a process, nevertheless, and that's why we provided you a term sheet for you to follow each of the steps if you're thinking about doing a flip. The flip, of course, if you start in Delaware, you don't have to worry about a flip. But the longer you remain a French company and you raise capital from French investors, the more complex the flip will become and more costly. But because we've done it many times, I think it's become much more of an efficient process. I want to talk about next. Are there any questions? Because now we'll move to the next act, which is certain kinds of financing, new financing vehicles. Question. Right. Yes. So the issue is, and the question was, why does it matter whether it's a U.S. company at the top and the French company as a sub, or the French company at the top and the U.S. company as a sub? For the perspective of most U.S. investors, and this is the $30 billion of capital that I'm mentioning, they will feel much more comfortable investing in the Delaware company. So when you raise capital, in almost all cases, it's the top company, that structure, that will be receiving the capital. And fundamentally, however, there's no real fundamental difference between the two structures. They're both corporations. They both provide limited liability. but the trend over many years has been to use Delaware companies as the vehicle. And in fact, if you look at most companies that are listed on NASDAQ, they're Delaware companies. Although interestingly, we're seeing more non-Delaware companies, foreign corporations and even French SAs that are listing in NASDAQ. But that's not the rule, that's the exception. And I think over time, it's just the path of least resistance to start as a Delaware company.
Also, when you say Delaware, I know that it's very advantageous
Yeah.
in terms of law.
Yes.
Business law, but
That's a good question. Why is Delaware?
there are many companies incorporated
Right.
in New Jersey,
Sure.
New York, or Pennsylvania.
Yes. Why is Delaware the preferred state? Actually, every state in the U.S. has a corporate law, so you could incorporate in Alaska or Idaho if you wanted to. But why Delaware? I've never been to Delaware, but one of the major businesses of the state of Delaware is corporations, and they have created special courts, which we call chancellery courts, which are courts to resolve corporate matters with expert judges. So you get a higher level of legal and judicial advice, but also I think just from a practical perspective in Delaware, it's very easy to deal with the state of Delaware. You can incorporate your company in Delaware in a matter of minutes, just online. And Clerky, for example, is one way to do that. But the state has made it very easy. You don't need to provide original signatures. You can do everything automatically, and they don't have anyone in Delaware who reviews the documents. For example, in California, when you incorporate in California or you do something in California, they have attorneys in California who work for the state who review what you submit. And so there's a bureaucratic process in California, but Delaware has eliminated the bureaucracy. Okay, financing trends. So this is interesting to see how quickly new trends catch on, because actually 3 years ago, we saw the advent of convertible notes as a way to finance companies. Before that, almost every company in their first capital in was in the form of equity. So investors purchased preferred stock in the company. It was costly to do so. It took lawyers on both sides to negotiate what the terms were of that preferred stock. And so convertible notes seem to be the trend, and the way convertible notes work, and it's a mechanism here that's used in with French companies as well, is the investors put the money in. Really the only thing they negotiate is the interest rate on the loan, how long the loan is outstanding. Usually it's 1 year. And at what point does it convert? So when the company raises Series A capital, the convertible note holder will have negotiated a valuation. So let me give you an example. We have many companies where the investors will put money in the company, such as $500,000, and it'll say that this convertible note will convert at a price no greater than $5 million. So when the company does a Series A financing, if it does a Series A financing at a $10 million pre-money valuation, that note negotiated a $5 million price. As a result, the note holder will get 2 times as many shares. They've locked in the price. Now, convertible notes, and I look at this a lot through the statistics from Y Combinator, were the predominant force in raising capital. In fact, we had over $500 million go into companies, just in the Y Combinator companies, before last year in the form of convertible notes. The term never really exceeded 1 year because U.S. investors could not loan for more than 1 year. Otherwise, they would be considered a lender and subject to those regulations. The issue for the founders is that after 1 year, if you did not do your Series A financing, you may be required to pay the money back to the angel investors, and you had an interest rate. You had this other phenomenon called phantom liquidation preference, which meant that when your note, in my example, converted, you got twice as many shares of Series A preferred stock, but each share of preferred stock has a liquidation preference. So if you put $500,000 in the company as a note holder, you're actually going to receive Series A shares that have a value of $1 million. And the problem is that you only paid $500,000, and there's a liquidation preference over the ordinary shares of $500,000. So that did not benefit the founders. So with these issues, last year in March, I co-authored with Y Combinator a new instrument called the SAFE, S-A-F-E. In fact, the word SAFE was it owes its origin to a good Cabernet Sauvignon at Alexander's Steakhouse in San Francisco, because we were talking with Y Combinator over dinner and decided, well, what do we call this thing? And so let's call this thing the SAFE. Who wouldn't want to buy an instrument called the SAFE? And what the SAFE is rather than being a convertible debt, it's convertible equity. And we launched it in March last year. We were quickly imitated. 500 startups created their security called the KISS. I'm just curious, who has heard of the SAFE and who has heard of the KISS? Okay. And in 1 year, $200 million, over $200 million has been raised under SAFEs for YC companies. And some companies have raised over $5 million in SAFEs. And the reason I mention this is relevant whether you're a Delaware company or whether you're a French company. And in fact, we have an equivalent here. It's a very useful instrument, I think, for you as founders. We have an equivalent for French companies called the BSA Air, which is the SAFE in terms of the French equivalent. And it has all of the same features as the convertible note, except there's no maturity date, so you don't pay the money back. There's no interest rate because it's not debt. And you can, as with convertible notes, you can do rolling closings and rolling valuations. So it's a simple instrument, and in fact, we have a term sheet here for a SAFE, so you can see what the SAFE looks like. But it can be done on a couple of pages, and in fact, we even work with Y Combinator on the clerky.com system to create SAFEs. But what you can do with the SAFE, all you really need to negotiate is the valuation cap. In some cases, investors will want a discount to the conversion price, but in most cases, it's a valuation cap. In fact, 80% of SAFEs and convertible notes have a valuation cap. So in my example with the $5 million or the $500,000 financing, rather than the investors putting capital in the company in equity, they will buy $500,000 of SAFEs at a $5 million cap, and when the company does its Series A financing, those SAFEs will convert. The other feature is we got rid of the phantom liquidation problem. So when you convert your SAFE into Series A preferred stock, you get twice as many shares as the Series A investor, but your shares of Series A have a lower liquidation preference. So your aggregate liquidation preference equals $500,000. So this benefits the founders as well. Investors in the SAFE, and this is the Y Combinator form of SAFE, have pro rata rights. And what that means is when the SAFE converts at a Series A financing, for future financings, Series B and so forth, those investors will have the right to maintain their percentage ownership in the company. There are some additional things that investors will ask for with the SAFE. They may ask for pro rata rights now as opposed to pro rata rights after the Series A financing, and usually this is done in the form of side letters. So for example, an investor who puts in $500,000 in the SAFE may ask that when you do your Series A financing, they have the right to invest another $500,000. So this is a form of pro rata rights. It's not the traditional form, but it is a form of pro rata rights that we see even at this early stage when you're talking about convertible securities in order to finance the company. Sometimes they'll have MFN, or you'll see this term a lot, most favored nations provisions, that says if the company sells them a SAFE at a $5 million valuation cap, but if it sells a SAFE to someone else at a $4 million valuation cap, then they have the right to adjust to the better terms. Sometimes investors now will ask for information rights, rights to financial information, or rights to participate in the board meetings as board observers. And sometimes investors who are putting money in the company will want to be, if they're advisors to the company, they will ask for common stock in the company. And we calculate the common stock sometimes in a way to reduce their average price. So if someone's issued 250,000 shares of common stock in addition to the SAFE, it may bring their average valuation cap from a 5 million down to a 2.5 million valuation. And so why am I talking so much about convertible notes and talking about SAFEs? And the reason is that for startups who have less capital now, and certainly less capital to spend on lawyers and accountants, that the convertible note and the SAFE is a cost-effective way to raise capital. As I mentioned earlier, we have some companies that have raised close to $5 million, and in those cases, their legal fees from the very beginning of the company for the incorporation, the negotiation of the SAFE, the negotiation of some of the side letters is less than $10,000. And when I go back over time, 10, 15 years, when companies were raising that amount of capital, $5 million, they could easily have legal fees close to $50,000 to do all of that. So these kinds of instruments are very company-friendly, founder-friendly, and they've resulted in lowering the cost, the startup costs for companies if you use standard forms. And that's another point I want to make is standardization is very important here. If you customize these documents, if you negotiate many different kinds of side letters and you create more complexity for the company over time, then it will lead to higher transaction costs. And the beautiful thing about the family and Y Combinator is with as many companies as these incubators are working with, is they are creating standards and also creating negotiating and buying power. And as a result, we have many companies that have introduced and used the SAFE, and investors are buying the SAFE. Andreessen Horowitz has bought the SAFE. Trinity Ventures has bought the SAFE. Sequoia Capital has bought the SAFE. So even US VCs who have their early stage funds and are investing $100,000 or $200,000 in companies have already in fact, I was just finishing a SAFE this afternoon with General Catalyst out of Boston for an investment, and they're making a $2 million investment in a company using a SAFE. And this is all a precursor to the Series A financing. So the investors understand and believe, and this is what the founders have told them, that this business requires more than $500,000 or $1 million, that in fact the next step in the business will be venture financing. And what the SAFE is a bridge essentially to that venture financing when all of these rights and all of the items that we left for now get negotiated. So that's the second part in terms of discussing the convertible securities. I'll open it up for any questions about the convertible securities. Yes.
What's the difference between a SAFE and KISS then?
Oh, okay. Yeah, good question. Not much. So I guess they liked what we did because they imitated us almost 100%. But the main difference between the KISS, which was created by 500 startups, and the SAFE, which we did with Y Combinator, is what happens if the company is sold. So after you've raised $500,000, let's say, and before you do a venture round, what happens if you decide to sell the company? What does the SAFE holder or what does the KISS holder get? And under the SAFE says that the investor has the choice either to receive their money back, so it's a 1x return, or they convert at the, let's say, the 5 million valuation, and if the company was sold for 10 million, they would do the economically rational step of converting, so they would get a 2x return because the company was sold at 10 million. They would not choose to get their money back. They would convert and sell the stock for 2x. What the KISS does is it gives the investors an automatic 2x return. So if the company is sold for $10 million, the same $5 million cap, it's the same between the SAFE and the KISS. But if the company sold for $5 million, the SAFE holder will receive the $500,000 or 1x back. But under the KISS, the investor will receive $1 million. So, and that comes out of the founder's piece. So it's more protection for the investors under the KISS, and that's the fundamental difference between the two. Question? Yeah. Sure. Yes. And, Algolia is a good example of that, which is has a team here in France, R&D, software development, and management and sales and marketing in the U.S. And investors are attracted by this model, which is high quality software engineers here. I mean, this is the argument when you're talking to U.S. investors as to why you're a French company or why you continue to have employees in France. And the argument that works, because I've seen it happen many times, is the fact that you have high quality employees here with a high degree of loyalty. One of the phenomena in Silicon Valley is that people move around a lot. The cost of labor, hiring people, believe it or not, is actually less in France than it is in San Francisco. Many engineers coming out of MIT and Stanford in their first jobs are making more than 120 and being employed by Google. Google is one of the highest, has one of the highest salaries in the Valley. And those ranges for initial software engineers are between $120,000 and $140,000 salary. The fully burdened cost to the company is more than $200,000 with benefits, et cetera. So it's quite expensive to have software engineers in Silicon Valley, in San Francisco. So one of the major advantages is the lower cost and high quality of engineers here in France. So we see many companies that are continuing, even though they obtain capital in the U.S., they continue to build their team here in Europe. And I think it's a terrific advantage for French companies to be able to have for U.S. investors.
Considering the exchange rate, it's a good time to do it.
And with the exchange rate, yes, it's even better. I'm going to talk real quickly about seed preferred. Seed preferred was a big trend. You saw many law firms create these forms that say, okay, you can do a preferred financing on the cheap. You can do it really easy. Just follow these forms. This did not take off because once investors think about making an investment in preferred stock, then they will negotiate all of the rights that go along with preferred stock. They will negotiate board participation. They will and negotiate the size of your employee stock pool. They will negotiate founder vesting and other terms. They will do more due diligence in the company. There's less flexibility in terms of prices. Unlike the SAFE or the convertible note, I could sell to you, if you're going to invest in my company, I could sell you a SAFE this afternoon with a $5 million valuation cap, and then I talk to some other investors tonight, and there's more momentum, and then tomorrow I'll sell to you a SAFE at a $7 million valuation cap. It doesn't need to be the same price, whereas with preferred stock, you're more constrained. It needs to be the same price for each series of preferred stock. So from a U.S. perspective, if you're raising your first seed capital, the seed preferred is not the dominant form right now to raise capital. So what is the process to get in front of investors in raising your seed capital? And I'm talking mainly about convertible notes and SAFEs right now. Obviously, partnering with incubators like the Family, Y Combinator, and 500 Startups. I think the level of success, the probability of success of companies that have an incubator relationship is much higher because of the network effect, the fact that the incubator has done a filtering process over the companies. And I work with many Y Combinator companies, and we see companies that have achieved a lot of, have been able to raise capital very easily. Not to mention the fact that with many of the incubators, you have initial capital. With Y Combinator, you have $200,000 of initial capital in the company. It's how many people have witnessed a sort of U.S. style demo pitch that founders do for companies, and how many of you have perfected your own pitch? This is very important to be able to, within 30 seconds, tell investors what you're doing, because the point I want to make is the benefit of networking. So networking is one of the, I think, the key ingredient to raising capital, and it's participating in events such as this, events where there's angel investors, and being able to articulate very quickly what your business is in 30 seconds or less. And that is really to make an initial introduction to an angel investor that you're speaking to. And angels flock together. That's another phenomenon. When we look at the capital that's been raised by companies in early stages, we see patterns between, well, of course, SV Angel. Ron Conway is the super angel in the Valley. He invests in about 2 companies per week. He's putting capital in, and he invested in Facebook and Google and LinkedIn and Zynga and Groupon. And his approach is more of a shotgun approach. He will, after about 30 seconds, be able to determine whether or not you go to the next stage, which is a meeting with him, a more intense meeting with him, but whether or not the team is an effective team, whether you can articulate your business, and they will make investments. They make investments in every Y Combinator company, for example. But I think the key here is to be able to articulate very quickly what you do. There's other platforms for raising capital that I wanted to mention. Angel List. There are many companies that are listed there. It's an online approach. I don't think it's as effective as getting out in person and meeting angels. And then also Kickstarter, which is not for raising equity capital. It's, as you know, it's for raising capital to fund, in most cases, product development. But I've had some companies that have done quite well on Kickstarter. I have a company that's called Boosted, which is electric skateboard. And their first capital came about via Kickstarter. I think actually they were one of the most successful Kickstarter campaigns. And then we went on to close a venture round, a Series A venture round. Khosla Ventures did their Series A, so we helped them with that. What's very important is limiting, however, while I talk about networking and shotgun approach and so forth, it's also important to limit the number of angel investors you have in the company. So go for quality versus quantity. And otherwise, you will have many investors that are on your cap table, and it will become an issue over time that you have to manage so many small investors. And also in the U.S., there's constraints on who those investors are. They need to be accredited investors, and I put the requirements on the board of what an accredited investor is. Another rule of thumb when you raise this seed capital, again, whether it's convertible notes or safes, is try not to sell more than 15% of the company. That's sort of the dilution that the maximum dilution that I recommend. So for example, if you're a company that's going to raise $1 million, somewhere between $500,000 and $1 million, and your target is not to dilute the company by more than 15%, what that means is that your pre-money valuation under these safes and under these convertible notes should not be less than $6 million. That's your pre. Your post is 7 million. 6 plus 1 is 7, and therefore 1 over 7 is a little bit less than 15%. Now you'll see some companies that may raise money at a 4 million pre. Maybe they'll raise 500,000 at a 4 million pre. They'll achieve some milestones over time. 3 or 6 months later, then they'll raise money at a 6 million pre, and then raise money at an 8 million pre. But overall, when you look at the dilution, the recommendation is not to, for your initial capital, the $500K to $1 million, is not to dilute the company by more than 5%. I just talked about getting into the angel community, then getting into the venture community. It's very important to understand the VCs that you're targeting, and even from their perspective, trying to find the best fit, and who is the best person to make an introduction into that VC. Lawyers play a big role in making introductions into the VCs, but I think the most effective approach is other entrepreneurs that have been funded by those VCs, other entrepreneurs who are successful or have made money for the VCs are also a successful company. For example, Patrick Collison at Stripe, he's very well respected, the Collison brothers at Sequoia. So an intro by Patrick to Mike Moritz at Sequoia is going to carry a lot of weight. So that's what I mean by leveraging your peers and publicly available information. You have to do research. You have to look at the venture funds, see what sectors they're in, who the entrepreneurs are, get onto LinkedIn and understand the connections between you and these entrepreneurs. Meet the VCs at networking events. Make sure that you're the right fit for the VC based on their sector and their stage. And then, get in front of the VC. They may not be interested initially, but I think there was Zamanta was a story that Fred Wilson invested in that company. It was actually I think an Estonian a founder of that company. It's a company that we worked with when they were getting started, and it was just a phenomenal result that at the end of the day, Union Square Ventures invested in this company. And when Fred Wilson was asked, well, why did you invest in the company? He said, well, I just started hearing about them all the time. And in fact, he was in the UK and the founder was in Estonia, and he was in London, and he sent an email to the founder, said, well, come meet with me. And after that meeting in London, he gave the investor a term sheet. And the reason was that for that initial meeting was that Fred Wilson kept hearing about the company. So I think it's using the network, using LinkedIn, different approaches to get into the mind share of the VC will produce these kinds of effects. Don't take no for an answer, but find ways to get known by the VC. I had this came from a slide over at Graycroft, another VC fund. They gave me these two slides just to talk about what the deal flow looks like from the VC perspective. So what Graycroft says is that they see the business plans that are coming in are increasing 50% per year. So there's a huge influx of business plans. Now, what we mean by business plan is an executive summary. So I mentioned the 30-second pitch. That's the first stage. The next stage is a 1 to 2 page executive summary that describes the business, talks about your backgrounds as entrepreneurs, describes the market, who the team is, and it's a very high-level summary. And so I think this result is experienced by many VCs, is this increase in business plans. So they have to sort through a lot of opportunities. Most of these are email introductions. So they see 300 new investment opportunities per month. And I think the statistic is right, that an active VC firm makes 1 investment per month. Now, there are others like Andreessen that are much more active than that. They're making more than 3 investments per month. But I think your average Silicon Valley venture fund is making 1 to 2 investments per month. But that's only after sorting through a lot of business plans. So this is what happens when you send the pitch to a VC. It's the initial email. They'll schedule a call or a meeting. Many VCs want to schedule a call first rather than an in-person meeting. Then a couple of weeks later, you may get an on-site meeting in their offices, whether it's in Silicon Valley or in New York. That'll be usually just with one partner and maybe with an associate. And if they continue to be interested, then they will do due diligence, which will be reference checks on you, your background, on the product, may call a couple of potential customers, do some market research, and if everything looks good, then the next step will be a full meeting in front of the full partnership of the venture fund. Most meetings of venture funds occur on Mondays. It's a historical thing where the VCs will be meeting with entrepreneurs and listen as a group to the opportunity. That initial contact at the venture fund will be your spokesperson, will be your advocate within the fund if they're interested in pursuing the opportunity. Coming out of that Monday meeting, if his or her partners say thumbs up, let's make this investment, will be a term sheet. And then what's interesting here is they said 1 to 2 weeks to close. It actually takes longer to close, somewhere between 2 and 4 weeks to close. But what's interesting is after the term sheet is done, the process moves over to the lawyers to get the deal done. And this is where you have quite a bit of due diligence on the legal side. You have the documentation. If you're a French company and you need to flip into the US, the flip will happen at that stage. Over 90% of companies do not get past the first meeting. So I put together a slide of sort of why do investors pass on opportunities. Again, it comes down to this fit with the investors. It may not be the right product or customers. It could be too early. The market could be outside of their focus, outside of their interest. The history of the company is important. Investors like companies that are capital efficient. If you've raised a lot of money already and the company hasn't gone anywhere and you have a lot of investors already in the company and you need to do what we call a recapitalization, then that's usually seen as a negative for the company. That is a pivot. Most companies, when they pivot with capital that they've already raised from early investors. They usually don't pivot as a result of raising new capital. So the history of the company is important. And then common reasons for passing after one meeting. Maybe they learned that the founder, CEO is not the right CEO for the company, or the team does not have level of confidence in the CEO. The founders may be asking for unrealistic valuations or amount of capital. This is one thing I noticed with founders here in the continent a lot is when you ask them, well, how much capital do they need to raise? They're usually thinking about, well, what are my capital requirements for the life of the business? So I may ask someone, well, how much capital do you need to raise? And they may say $20 million. And they haven't raised any capital yet, which is not uncommon to raise $20 million. We have companies like Stripe that have raised, $100 million or more. But when a U.S. investor asks, what is your capital requirements, they're referring to your initial capital, the capital you need over the next 12 to 18 months, which could be $2 million or $5 million. So just being realistic in terms of how you communicate what the capital requirements are is important. Competition. If you're in a crowded area with a lot of well-funded companies, this will be a negative, and this will be something that the VCs will determine after they've done, as I mentioned, market research. Or the market is too small to build a large company. And then once they get into further due diligence, they may discover after they've talked to customers that the customers really are not sticking with the company. There's a high churn rate in customers. The sales model is not predictable. It's inconsistent. The business plan is fiction. It just doesn't have realistic projections about it. Or that the technology is not stable. There's significant technical risk. And the background of the founders, that the references don't look good. So these sort of things come out later in the process. And as I mentioned earlier, the due diligence is a continuing process with the VCs in terms of getting engaged with them. So how to get investors' attention? I think being a repeat entrepreneur, having built a successful company before with a high quality team, that is A plus. Investors like to invest in serial entrepreneurs. I put some metrics down in terms of what kind of traction will VCs like to see. And again, where we are in the timeline here is this is after you've raised some of the seed capital that I mentioned. And now you're talking to institutional Silicon Valley type venture capitalists. So we start to see some traction in terms of revenue for a software company per month or for a commerce company. Significant users, 1 million plus users for consumer web businesses, and fast growth. I think that's the key, is seeing some acceleration and traction in the market. Low paid-in capital. From an investor's perspective, they will want to see that you've been able to achieve these metrics on low capital, that you didn't raise $10 million in order to get there, that you were able to do that on $500,000 up to $2 million in terms of being efficient in the way you have deployed your capital, and that you've built the business on a scalable, efficient model. That the seed round that I mentioned earlier was done at a normal valuation, and that it sends this signal to the USVC that you view investors as partners, not just for purposes of selling stock in the company, but you want to be on the same side as the investors in terms of helping to build value for them as well. So some people ask me, well, I have an investor who is willing to buy a safe at a 20 million pre-money valuation. And that's usually the wrong thing to do, because you do want to set the stage for having flexibility in terms of raising capital. You don't want disappointed shareholders on your cap table. Even if they're small shareholders, they will be a thorn in your side as you build the company. On the other hand, instruments like the safe and convertible notes do give you more flexibility to incrementally raise capital as you build value. And they want to see a big market with few incumbents. Question back there.
You give some amount for software companies. What about the hardware companies?
Yeah. So with hardware companies, I think it's about the same in terms of they're going to look at the adoption of the hardware in the market among consumers. So, do you have are you able to show repeat customers, repeat traction with the market? I'm not so focused on, I don't think they're so focused on revenue for hardware companies, as opposed to, do they believe you're going to get widespread adoption in the hardware device? So I would focus more on sort of number of customers, and is this just an early adopter phenomenon, or do you think you can get broad market appeal? I actually think Kickstarter is a good approach to test the market, not only from your perspective as a company to raise capital to fund the hardware if it's a consumer hardware device, but also to be able to signal to the investor that this is a product that can be broadly adopted, and Kickstarter is a good example of that. And I actually think that in the case of Boosted, that's one of the facts that attracted their investor to the company was that they had wide appeal on the Kickstarter project. Question?
Could you specify what you mean by fast growth?
About what? I'm sorry?
By fast growth, what rate do you mean? Like 20% per week or?
Oh, what rate of growth?
Yeah.
Well, I think most investors, and the question was, what are the metrics for rate of growth? So most investors will look at growth on a monthly basis, so month over month growth. So I think in terms of doing your projections, I would do them month over month growth. So 10% to 25% month over month as an early stage company is growth rates that I think will get them a lot of attention, so that you're doubling every 6 months in terms of the number of customers that you have in your pipeline at this stage. Other questions? So once you've gone through the process, the due diligence process I mentioned with U.S. investors, I've got one company now where they timed it. Question?
I can't believe that 300 companies a month approach VCs with that kind of numbers. So.
And I think that's why the question was, do 300 companies approach them? Yeah, right. Do 300 companies approach each VC with these kind of metrics? The answer is no. Yeah. This is why Graycroft gave me the slides, because he said, please tell people this is what we're looking for, so we don't have to work so hard. Many times in the pitches or the executive summaries that come in, the metrics are not there. So it puts a lot of effort on the VC to then have the phone call, ask the same questions over and over again. So it's a process. What is ideal when raising capital is having multiple investors chasing you. And this is an important thing to pull off, because it creates incredible leverage for you as a founder and as a company, and to receive multiple term sheets from investors. I have a company right now in the food service, food delivery space, and we have 3 term sheets, and it's terrific. And in fact, we've run this process where we're actually in the driver's seat, and rather than waiting for the investor to submit their term sheet to us, we've created our model term sheet. And in fact, we have a copy of a model Series A term sheet in the materials. What you have in the materials are 3 things. You have a flip term sheet, you have a safe term sheet, and you have a model Series A term sheet. And so it's great to be in the driver's seat, because it makes the negotiation a lot easier. In a venture deal, and I'll summarize them briefly in a second, but there are 20 to 25 terms that need to be negotiated with VCs. And if you have leverage and you're in the driver's seat, you can eliminate or limit the number of terms that will need to be negotiated. To items such as, what is the valuation of the company, how much capital you're going to raise, what percent of the company are you going to put aside in a stock pool and reserved for future employees, what the composition of the board is. These are the sort of the fundamental ownership and control and voting issues that you will negotiate. All the other topics, if you have the leverage and they're in your model term sheet, I guarantee the VC is not going to negotiate these things. So whoever has the advantage of proposing the term sheet will get a better deal. And so we want to be in the position to propose the term sheet. That works mostly when you know you've got multiple investors who are chasing you. If you only have one investor, you might not want to be so presumptuous to give them your term sheet. Usually you will wait for them to give you their term sheet. But once you have one term sheet, if you expect a term sheet from another investor, then you can turn the process around. A very important rule of thumb is not to disclose to one investor who the other investors are by name. You can discuss with other investors that you are running a process, you're discussing with other investors, you expect term sheets from others, or that you have received a term sheet. But it's very important not to disclose the identity, because in the venture community, people talk and they know each other, and if they believe that they will lose a deal and they know who the other investor is, they will instantly call them and say, let's do this together. And so then you will have a collusion result. And it's not a bad intent. It's just the way investors work. They both want to get in the deal. And so you've lost your leverage, and now you're negotiating instead of separate deals with the investors, you're negotiating with them as a block. As you negotiate, if you have multiple term sheets, you may decide that you want 2 investors rather than just one. And so what you'll do is secure your best terms on one term sheet, and then approach the other investor and bring them in on those best terms. But that only happens at the very end of the term sheet negotiation. It's important to have advisors, your lawyers, other advisors, and founders advising you on these negotiations and terms, and those, in fact, who know the VCs that you're talking to, because different VCs have different issues that are important to them. For example, I've discussed many term sheets with Andreessen Horowitz. I know what they will agree to, what they won't agree to, in items such as dual class voting, which is a new topic on the scene, size of option pool. For some VCs, they will insist that the option pool be 15%, but other funds will be okay with a smaller option pool. Founder vesting is a very important term. Will they require that you vest, all of your shares, or put them subject to a vesting schedule, as opposed to giving you credit for the vesting that you already have? So there's different flavors for VCs, different ways to negotiate with different VCs. Throughout the process, this is really important, and goes to our metric question earlier, is continue to build the business. Don't lose sight on building the business, because raising capital can be in and of itself a full-time job. So what are the common mistakes that founders make in raising capital? Is not understanding how valuation is calculated. Many investors will say, well, I'll invest at a 10 million pre-money valuation, and that may sound great, but what's hidden in that is the assumption that, well, all of the convertible notes and all the safes that you raised, if that's $2 million worth of that, well, that's included in the pre-money valuation, and your 20% option pool is included in the $20 million valuation. So while you may have heard 10 million valuation, in fact, when you deduct for the convertible instruments and you deduct for the pool, your actual pre-money valuation is a 6 million pre-money valuation. So it's important to understand what is in the pre versus what is in the post in terms of valuation discussions. Getting caught in the weeds and missing the big picture. I think when it comes down to negotiating a term sheet, there are 4 or 5 major issues to be addressed. And I do have founders where we get deal fatigue, where the term sheet goes on for weeks of negotiation over every point of the term sheet. And that really jeopardizes the deal. So it's important when you have advisors help you focus on what are the major issues that you need to be negotiating. Getting starstruck by a big name. Sometimes people are starstruck by the name of the fund as opposed to the individual partner within that fund who's going to be your advocate, who's going to sit on your board of directors and who's going to help you build the company and really truly understand the industry that you're in. So I would much favor the one-on-one approach in terms of building a relationship with a partner within the venture fund as opposed to the venture fund itself. Whatever you do in the Series A financing is going to set precedent for next rounds of financing, whether it's board control, whether it's founder vesting, whether it's the terms that you offer your preferred investors. So your Series A financing is the most important financing you will do. It will actually be the most complex. It'll be the most financing subject to the most negotiation. You will be converting all of these other seed instruments into equity. You'll be putting in place your stock option plan. You'll be doing the agreements with the founders, such as the founder vesting. So it is the big event for the company. If it's done properly, if you've built the right foundation for the company, then the Series B and C and D financing will go a lot easier. I advised Docker, for example, on their financing, which was in their Series A financing, where they brought in Benchmark and Trinity in Ventures. Both Benchmark and Trinity wanted to do the deal. They wanted to own the whole deal for Docker. But we were able to negotiate to bring them in the round together. And we worked out all the terms of the Series A, and we built a platform for the company to raise Series B, C, and following on terms that are beneficial for the company and even beneficial for the early investors. So each round after the Series A became easier. So what are the key terms? I touched upon this earlier. Pre-money versus post-money. I already talked about that. Control, board and stockholder control, exit mechanics, and founder restrictions. And these 4 bullet points will be the last bullet points I'll go through, and then we can have some additional Q&A. As I mentioned earlier, for companies, even in the Series A round, the capital that is needed is usually looking out 12 to 18 months. It's not the $20 million you need, but it's usually $3 to $5 million for Series A. What's interesting, however, is I do have some companies that have raised $1 to $2 million in seed, and now they're doing $10 million Series A financing. In fact, I have two companies now that are raising $10 million on a $40 million pre-money valuation. This is a Series A financing. And I think that illustrates the swing in valuations. Sometimes you hear people say 10 million pre, 40 million pre. What's really going on here? Valuation is in fact not the first variable in negotiating the financing round. What's most important to the venture capitalists is their percentage ownership in the company. And I'm certain most of you have heard this before, but what most US VCs want is a minimum of 20% ownership in the company. So if you propose to them that you need, for example, $5 million over the next 12 to 18 months, and a 20% ownership, that results in a pre-money valuation somewhere in the high teens, low $20 million range. And again, that pre-money will get ratcheted down because of option pool dilution and the other angel funds that will convert into that Series A. What do I usually see in terms of stock plan? It's very important to be realistic in terms of the stock options that you need to grant employees, again, over the next 12 to 18 months. It's not over the next 3 years. And in fact, you believe that you don't need to grant 20% of the company to hire employees to build out the product, then it's to your advantage to show a budget that is less than that, because all that dilution is going to be suffered by you as founders right now. So I have several Series A deals, even the company that I mentioned now that's raising money at a 40 million pre-money valuation. We agreed upon a 10% option pool. We're going to raise $10 million. We're going to employ a lot of people. We're going to hire a lot of people. But in fact, our business model does not require that we grant options or significant ownership to our employees. It's a different kind of business model. So we're able to minimize dilution by having a smaller stock option pool. And the result of all of this is that at the end of the day, if you can achieve owning 50% or more of the company after your Series A, that is terrific. And I think that founders who've been able to do that through their Series Seed and get into Series A, who've been able to maintain 50%, have done a terrific job. I do have founders where, as a group, they're closer to 40%. So 40 to 50% of the company on a fully diluted basis tends to be the range. That's valuation. Next topic is control. What does it look like in terms of selling control? And the control really is at two levels. It's at the board level and at the stockholder level. Interestingly, VCs, from my point of view, are not interested in affirmative control. They don't want to control the company. And I see this through all the deals that I do, that in most cases you see boards of directors after Series A that are either 3 board members or 5 board members, and the founders have the right to appoint a majority of those board members. There may be an independent board member, but even in the case of independent board members, I usually negotiate for the founders that they have the right to appoint the independent board member. Independent meaning that person is not an employee of the company. And so long as the independent board member is acceptable to the investors, then the investors are fine with that result. So most investors don't want control. They will want certain veto rights on things. For example, they will say, well, after we invest, if you decide that you're going to raise debt of more than $500,000, we want the right to veto that. Or if you're going to change the executive team, we want the right to veto that. So there are a number of items that will be negotiated, specific items over which investor approval or board approval by the investor representative may be required. At the stockholder level, there are a number of voting items, and this is all in the Delaware restated certificate of incorporation that gets filed. In most cases, preferred stock will have majority votes. So you will have, as a preferred stock, the right to approve certain things, such as sale of the company, next round financing, incurring debt. So your relationship with your investors is one of a partnership. So let's suppose that you did your seed financing round. You ended up diluting the company by about 15% as a result of the seed financing. Now you've brought Sequoia Capital in as an investor. They're going to own 20 or 25% of the company. They will own more of the Series A preferred stock than the 10 or 15 angel investors who came in as your seed investors. That's actually a good thing, because it means that on these items like company sale, next round financing, and other items, you only need the approval of Sequoia to get things done. You don't need to go beyond that. And that makes it administratively easier for you, but it really is a relationship of trust between you and the investor. And this is why it's important that you have a good one-on-one relationship with your investor. Another element of control that investors have is pro rata rights. So each time you do another round of financing, in my example, let's say Sequoia owns 20% of the company. When you do your Series B financing, they will also want 20% of that round of financing. So if your Series B happens to be a $10 million round, they will have the right to buy $2 million out of that $10 million, leaving $8 million left over for new investors. And this is why it's important, if you can, to limit the pro rata rights of the early investors, certainly those who are smaller investors, because if everyone has pro rata rights, then when you do subsequent rounds of financing, you will have less available for new investors. And new investors, just like the Series A investors, they also want a big piece of the company. They want 15 or 20% of the company. So with regard to pro rata rights, many times for the angel investors, we will say, if you invested above a certain level, if you were an angel investor who invested $500,000 or more in the company, then you will have pro rata rights, but not below that. Exit mechanics. I talked about this earlier. What's the benefit of being a Delaware company is that you can do a merger. You can sell the company without having to do a share transaction. A share transaction means that every stockholder in the company needs to sign a document saying, I agree to sell my shares for such and such price. Whereas in a merger transaction, so long as you have 50% of your preferred stock, in most cases, and 50% of the overall shares, you can sell the company without needing to get the consent of your stockholders. So and by operation of law, it makes it much more effective to sell a company as a Delaware company. We do put in place, however, drag-along provisions, and actually this is something that I think became very popular, and is the case in French companies, the pacte d'actionnaire that has the drag-along that says, so long as a certain number of shareholders agree to sell the company, if 50% of the preferred wants to sell the company, then everyone else will agree to sell the company. So we're starting to put drag-along provisions in U.S.-style documents as well. And what do investors get? I mean, the main thing that investors are looking for on sale of the company is a rate of return. And they're looking for upside return, 5, 10x their investment. But they will negotiate, and one of the items that is important in term sheets, their liquidation preference. What happens if the company fails? You know, what will they get if the company is not sold for a high valuation? And you'll see these terms, but in most cases, what investors will receive is what we call a 1x non-participating preferred stock, which means if the company is sold, they get the choice between their money back or what they would have received had they been common stock, had they converted their preferred stock to common stock. So they have the choice between their money back or what their percentage ownership in the company is. The other item is fully participating preferred that says on sale of the company, the investors get $10 million back, for example, is the amount that went in the company, but then they also get their percentage ownership of the company. So for example, if you had a company that was sold for $100 million and you had full participating preferred, and you had investors who owned 50% of the company, those investors would first receive 10 million out of the 100 million. That leaves 90 million left to divide, and that 90 million would be divided 50-50. So the investors would receive 45 plus 10, or 55 million, and the founders would get 45 million. So it's a 55-45 split in a full participating preferred model. But again, in most models, it's a non-participating preferred. So if the company is sold for $100 million, the investors have a choice. Either receive my $10 million or convert my preferred into common, and I get the same percentage ownership that the founders get. So I have a choice between receiving 10 million or receiving 50 million. And in that case, it's a 50-50 split. So there's no double dipping. They don't get both. But this is an important provision to negotiate. And so this chart shows what happens in a non-participating world, which is at lower valuations. So the x-axis is valuations, and the y-axis is price per share. So as the company achieves a higher valuation in a non-participating world, there is a point at which it makes economically rational sense for the investor to say, I'm not going to take my 10 million. In fact, do we have some mathematicians? At what point do investors who own 50% of the company decide they're not going to take their 10 million? What's the valuation point at which they decide they're going to convert into common stock? Some quick math. Okay, it's $20 million, because above 20 million, if the company's sold for 22 million, the investors will convert because they'll get $11 million. And if it's less than 22 million, they'll just take the $10 million. So that's the non-participating world. And then in the fully participating world, which is the example I mentioned earlier that you don't want to negotiate, you'll see that these lines never cross, that the investors are always receiving more per share on sale of the company than the founders. The investors are the blue line here, and the founders are the red line. Founder restrictions, the other topic on negotiating with US VCs, reverse vesting. So even though many times founders have already put a vesting schedule in place, the VC may come back and say, we still want you to reverse vest. So if you've invested in 50% of your shares, we think that's too much. We want you to dial back and invest in or vest in some of your shares. And what that means is if you're a founder and you're terminated by the company, then the company has the right to repurchase your shares, your unvested shares. I do, at this stage in the negotiation, want to make sure that founders have acceleration of vesting. So if the company is acquired and then they're terminated post-acquisition, that they have all of their shares, 100% acceleration of vesting. Also, investors will require that you put restrictions on your ability to sell shares. And in this category, I like to have founders have the ability to sell at least 15% of their holdings without having to give the investors a right of first refusal or a co-sale right on their shares. And I'm sure you've read about that there's a huge market now in founder liquidity. As companies go into Series B and Series C financing, founders are selling ownership in their companies. Usually it's 5%. Very rarely do I see founders selling more than 5% of their holdings, but nevertheless having the flexibility to do so and go out and get offers from third parties if you want, and negotiate with existing investors or negotiate with future investors is an important power to have as a founder to get a high price if you want to take some risk off the table and get some early liquidity. It actually serves investors well as well, because for later stage investors, they want to buy a bigger percentage of the company, and early investors don't want to get diluted. So by later investors buying some of the founder's piece, it doesn't create any dilution for the earlier investors, and it enables the later investors to buy a greater percentage of the company. So this is what I'm seeing now is a lot of what we call secondary transactions. And the last point is usually founders do not need to make any representations to the investors. Representations about the business, representations about the IP, representations about taxes and other things. So for an American-style venture round, all of the representations are made by the company. The founders don't make any guarantees, personal guarantees or guarantees of their shares. So it's important. I see this a lot in European-style deals where investors are asking the founders to make personal representation. So that is not the approach on the U.S. side. So I think that summarized a lot of the key terms in venture, valuations, control issues, exit mechanics, and what investors expect, and then founder restrictions. Those are the four major categories. And as I mentioned, there's more than that, 20 to 25 terms. But if you have the leverage in negotiating your deal, your model term sheet, then it'll make the process a lot easier. Questions?
You didn't talk much about the early angel investors. And should they be treated the same way that the founders are? Should they be able to access liquidity in a secondary transaction, etc.?
Yeah, so the question is, what sort of liquidity do you see for angel investors? What's interesting is angel investors don't, in my experience, ask for liquidity. Very rarely do I see angel investors selling their ownership to later stage investors. And in fact, the opposite occurs where I see angels coming back and trying to buy shares from founders because, let's take the Ron Conway example, where he's investing in 2 companies per week. And if there's companies that start to take off, then there's a huge opportunity to double down. If you play poker, double down in the opportunities. Now, actually, what's interesting about Ron Conway is as a philosophy, he does not invest again. He only invests one time, as opposed to many angel investors where once they invest, they will want to invest in subsequent financing rounds as the company achieves greater success. So in terms of negotiating rights for angels to get liquidity, they don't push for it. And in fact, a trend nowadays is to restrict angels from selling because we want to control the stockholders who are in the company. Keep it a limited set of people that we know as opposed to bringing in new investors.
But do you think that the founders should be allowed to sell if the angels are not?
Yes, and again, should the founders be able to sell if the angels are not? That is what's happening. I mean, in most of the companies I have where we have founder liquidity, it's the founders who are selling and the angels are not. But if the angels chose to sell, they would find a market to sell. But what the angels don't have is contractual rights. The angels don't have the right that says, if I'm a founder and I'm selling, I have to share that opportunity with the angel. Those rights are not being negotiated by angels. And that's actually very different, I think, than on the French side, which you see are these co-sale rights that apply to everyone. So if anyone sells, anyone else who's a stockholder in the company has the right to sell alongside. And in the U.S. side, you just see that with the major investors. While they never sell, they usually ask for co-sale rights. And I've never seen a U.S. venture investor exercise their co-sale rights if a founder decides to sell. So in these cases, in the U.S. style, if founders want to sell, they are selling, and other investors are not exercising or do not have the right to sell alongside them. I think, why do major funds like Sequoia and Andreessen want these so-called co-sale rights? They're worried about the doomsday scenario where the founder decides, I'm selling all of my ownership in the company, I'm exiting. And this is really just to prevent the doomsday scenario. Other questions?
That goes back to Delaware registering. Is there a too soon or too late moment to incorporate?
Good question. When do you incorporate? What's the timeline? I mean, once you incorporate, you're you have this legal entity that you have to pay taxes on, because in Delaware you pay about $1,000 a year to maintain the company. So it's a tax and fiscal liability for you just to have the corporation. So the rule of thumb I suggest is, if you are engaging with third parties, if you're going to sign a contract with a third party, which could be an employee or a consultant, once you start to hire people, then you should be a corporation. Or if you're bringing on customers, you should be a corporation at that point. If you're doing product development solo, you don't need to incorporate. But if you're doing product development with others and you want to make sure that you have the IP ownership, you're securing your IP ownership, then you should incorporate and use the forms to make sure that whatever your consultants are doing, your software developers, your employees are doing, that the company in fact owns that intellectual property. And that is actually one of the most significant due diligence issues and problems that come up when I take on a client that's already been around for a little bit, is that there's not clear title. There's uncertainty around who owns the IP, and did we get people who were contributing to the product development to sign a contract where they assign or sell the IP to the company in exchange for their services. So it's very important to have those forms in place. And then also it's liability protection, particularly in the US side. What a corporation gives you is, if you have a customer who's not happy, or if you have an employee who's not happy and they sue you, they go to court, then you can stand behind and be protected by the corporation, as opposed to being personally liable for whatever that liability is. Question? It depends on what kind of insurance. Yeah, it's actually an important point, which is early on in the life of the company, the question was around insurance. There's a lot of insurance out there, and I do recommend that companies buy insurance. So it's insurance around workers' compensation, which is actually a requirement to have workers' comp insurance. Commercial insurance. There are insurance policies that will insure you for breach of contract by customers, or other liability that you might have from third party, some intellectual property insurance. So it's always important to look at what kind of insurance policies, and that most companies don't bother looking at insurance until they do their Series A financing, however. But at a minimum, I would recommend some kind of employment insurance against employee claims. Question?
I'm interested in the due diligence process. Do you recommend making your documents, even though you're a French company, in English, so that it's easier later on if you intend to be an international company, just for the sake of it?
Yeah, so the question is, in terms of due diligence, is it better to have your documents in English versus French or another major contract? The answer is yes, because if you're going to, investors will due diligence everything. They'll due diligence all your contracts. Even corporate partners will due diligence a lot of your contracts on acquisition of the company. There will be due diligence. You can have different choices of law. For example, you could have a English written contract governed by French law, and French courts are very favorable to companies in terms of being able to resolve disputes and how attorney's fees gets awarded. And if you're in a French court, it might actually be beneficial, less likely that an American company will sue you if you're in a French court than if you're in a Delaware or a New York court. So there are advantages to using the French legal system to protect you against liability. But in terms of where the contract is written, yes, I'd recommend that the contract be in English. Question back?
Let's say you're starting to network and looking for a seed fund. Do you need a legal presence with a company name registered somewhere, or you're fine with, like, say, you copyright on your name and a LinkedIn page? Do you need something serious registered?
Sure. So the question was, how do you? At what point do you register your name? Are you speaking after you've incorporated the company, or before you've incorporated the company? Both. Yeah. So company name. So I think the domain name is very important. Most founders will start to build their brand. I mean, what you're doing is building brand, and you're building goodwill, and there's a value in that brand. So most companies will first focus on the domain name, and I think that is the right thing to do, is focus on the domain name initially, even before you've incorporated the company. And let's suppose that when you go to incorporate the company, you discover that there's another company out there. In fact, I just had this with a company that I represent called Magic, which is a new company that is doing services for text by text. And the company was called Plus Labs before in Delaware. But they've now been promoting the company as Magic. But it turns out that in California, you can't have a company called Magic. So we're calling the company Magic Services in California. But the overall brand that we started with from the very beginning is Magic. And your brand name doesn't need to be the same as your company name. So it can be slightly different, or it could be totally different. So I think the question comes down to, what is the brand that you want to build? And the domain name, in my mind, is the first thing that you do. If you can secure a name for a corporate name in Delaware, then that's fine. If it's similar. If it's totally different, you may decide, like, for example, I work with a company called Open Garden. That is their company name. But they have Fire Chat as their service. So they basically operate under both names. But that's, Fire Chat is the name that the consumers understand, but the company is incorporated as Open Garden. I hope that answered your question. Oh, and I should just mention, so you have got domain name, you have the company name in Delaware, but then in the U.S., and it's the same as in Europe, you want to get trademark protection if you can on your name. Companies like Stripe, for example, we help them get trademark protection on their name. So it's now a federally registered trademark in the U.S., and they have counterpart registrations in other companies, in other countries. So what is the benefit of a federal trademark registration is that if anyone violates your name, if they're using Stripe in the context of software services for payments, then Stripe not only can sue them for damages, but it can sue them for 3 times what we call treble damages, the amount of damages. So it gives a lot of force behind the trademark if it's a federal trademark. So this is why at some point it's important to use some of the capital that you've raised in the seed round, if the name is really important, to then start to pursue the U.S. federal and the European trademark protections over that name. And that protection is in the specific sector that you're in. It's not a broad protection, but it's sector by sector. Question?
You see a lot of polluters on the internet buying names that they think will do well or so on. Do you have, or let's say a company is supposed to be known and people book the names internationally, so book them locally. Do you see the same thing in trademarks or not? Or is it more difficult?
Yes, in trademarks, you have to have a real business. You have to demonstrate that the mark. So the question was, you have people who are buying domain names, sitting on them, and just monetizing those domain names. Does that happen in the world of trademarks? And the answer is it does not, because in order to have a trademark, you have to demonstrate to the U.S. PTO, the Patent and Trademark Office, that you've used that trademark in commerce. So you can't just wholesale buy a bunch of trademarks. And the other thing I should mention is prosecuting. We use the word prosecuting, but that means following the application of a trademark costs money. It's not simply a $100 domain name. It ends up costing several $1,000s to prosecute the trademark and get it approved by the U.S. PTO. Correct. Yes. 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 Yeah. So therefore, in terms of priorities and timing, it's better to focus on the domain name first, using the capital to secure, similar domain names across different domains, as opposed to the trademark application. If you are to do a trademark application, do it in the major markets. Do one application for Europe, and one application for the U.S. But in fact, a trademark application doesn't cost that much. It's a couple of $1,000s, so it's still worth it to pursue a trademark application.
Say it was for active businesses, for example, you cannot register a trademark because you're not active.
Yes.
Apply also for unused products, for example, big companies that are trademarked in the 90s and tries now to keep it, but the product is not used anymore.
Yeah. So the question is, what happens to the trademark over time? Does it expire? Do you have to keep using the mark? The answer is no. You don't have to, although someone can file against you and say, the mark is no longer in use. But the presumption is on the other side, that the other side has to demonstrate that you're not using the mark. It's on a third party to make that determination. It's not the trademark office will not, keep track of you and say at some point, the mark is no longer being used, and therefore you automatically lose the license. Okay. Question back.
Is it easy to mix some VC from different countries, different cultures? Should we avoid it, or is it a good thing to do?
That's a good question. Is it easy to mix VCs from different countries or different cultures? I'm trying to think of examples where we have VCs in different. I think when you talk about institutional VCs, I think the answer is yes. They have a track record in many cases of working together. I'm thinking about most of the French funds right now, like Partech and Exange, the larger French funds, Exange and Serena Capital, and ID Invest. I think they've invested many times with UK or US investors. What I think would be helpful is for more US VCs to have contacts with earlier stage funds in France to provide leads for those companies. Because in the Silicon Valley, it's the angel investors, I think, who are some of the major sources of good leads for later stage investors. So establishing more connections between early stage funds here, angel funds in France, and later stage U.S. investors would be terrific. And we're actually starting to see some early stage funds like Funders Guild out of New York. They've invested in a couple of French companies here. One called Happen, which is a dating company. They're a U.S. seed investor. We don't see too many. There's another one called Storm Ventures. They invested in Algolia. They came in the safe. They bought a safe in Algolia. And we at Orrick are starting to track, who are the early stage investors coming into the French from the U.S. coming into the French market, because in some ways I think that will create significant momentum if you see early stage investors from the U.S. come into the French market, because they have the natural back channel, to the later stage investors. And that's exactly what happened, I think, with Algolia, which had three major points, which was coming through the family was important to be behind that company. Second was Y Combinator. And the third was getting some of the seed capital from U.S. investors. And now the company is, in the process of raising additional capital from U.S. investors. How are we on time? I think we're probably good. Any other questions, and then we can wrap up back there.
Let's say I
Yeah. Oh, he's thinking like a lawyer, you know, this is good. So, yes, actually, it's actually a good thing you can do. You create your French company, you set up a subsidiary. Oh, so the question was, what happens if I have a U.S. Subsidiary? Does it change when I flip? And so the answer is that if you have a French company, you set up a U.S. subsidiary. We set it up very easily. You have 1,000 shares in the U.S. subsidiary. The French company owns all of those 1,000 shares, and we say, okay, write a check for $1,000, and you put $1,000 in a bank account, and now you're done. It happens in 2 seconds, right? But down the road, if you now, and then you're going to invest in that company, you've got a name that you like. It could be, you know, the U.S. version of your French company name. What name do you have in mind, for example?
Well, my name works in English, but
What is it?
Sport Easy.
Okay, so you would have Sport Easy SAS, and then you have Sport Easy, comma Inc. Okay, and then when you want to flip, you can use that company, which is now a wholly owned sub, and you invert it. So that becomes the holding company, and the French company becomes the subsidiary underneath it. So the bottom line is you can invest in that company. You can do contracts with employees, contracts with customers, do all of your registrations that you need in the U.S., and you're not going to be wasting effort because you can use all of that in the holding company if and when you decide to flip. It's useful. Yeah, there's no reason not to incorporate a subsidiary in the U.S. if you want to do business in the U.S. Good question.
And by the way, what kind of corporation are you talking about? I mean, are you talking LLC, C Corp? I mean, could you?
Sure. There's a lot of different variations of corporations in the U.S. C Corps, S Corps, B Corps is another one, which is a public benefit corporation, LLCs. But 99.9% of all companies are C Corps. And the reason is that's the form of corporation that U.S. investors will invest in. There's some real restrictions on U.S. investors investing in any other type of corporation. So if you want venture capital, it makes sense to start initially start as a C Corp. Okay. Great. Well, thanks for the good questions, and it was a real pleasure to speak with you tonight, and I look forward to catching up with you after this. Thanks again.